Okay, welcome back, everybody, to episode 101 of the Volatility Barometer podcast. So markets are down. It's getting a little scary out there. It's really only about 6% so far, so not the end of the world. But of course, with Trump out there, essentially just flooding the news cycle, it's actually really hard to keep up with it all. So there's going to be plenty to talk about today. You can see we will do our open Q&A, so feel free to get your questions in the chat. I will get to those later. But the first segment, I think I want to illustrate why now more than ever, it is important for investors to adopt the tactical rotation style investing. It really can save you from riding the next market crash right off that cliff. So definitely going to get to that. Segment 2, I just want to show how shorting volatility, shorting the VXX, when the VIX index gets into the 20s like it is now, how that might not be the great idea that a lot of traders out there think it is. But let's start the live stream off right. Smash the like button for me. Of course, subscribe to the channel if you are not, and let's get into the first segment. Okay, so like I said, tactical investing. Now, nobody knows what's going to happen going forward. Of course, we don't know whether this current crash is going to be the big one or whether things will kind of calm down and go back towards the all-time highs. We don't know that. But I think one thing that a wise investor could at least acknowledge is that we may be at the tail end of this fairly long bull market cycle. Now, of course, we had the pandemic, but does that even really count? It was a massive V bottom. They flooded the market with capital. Not a whole lot happened then. It's actually been a pretty long time since we've seen an extended recession. So it is wise for investors to know that at some point that's going to happen. And like I said, I believe tactical investing style is what's going to save people and allow you to thrive in that environment. Now, I've got a lot of videos on the channel about this. I'm not going to really get into what it is, but just super quick to catch everybody up. This is our tactical volatility strategy. And with this one, I'm dividing the market up into different volatility ranges, and then I'm only allocating capital to the asset classes that perform best during those ranges. So of course, during stable, calm markets, there's absolutely nothing wrong with being aggressive. We'll be holding short volatility in that range. But when the metrics elevate and they're showing risk, this is when we move into the GLD gold for safety. And then in extreme volatility, when those levels are really high, this is only on about 2 or 3% of trading days, but there are times when we can actually flip the switch and go long volatility and actually try to capitalize and make a profit during the market crash. This is what I mean by tactical investing. And within this strategy right now, we are actually in gold. We've been in gold for a couple of weeks, kind of in that middle wait and see ground. Not high enough to go long volatility, but certainly we've seen the market go down and we were lucky enough to avoid most of that. Defensive rotation is another tactical investing strategy. This one using different volatility metrics, different ranges, different asset classes. This is how you diversify a portfolio using different strategies. And this one is currently in cash, so it's been safe for a while now. And then strategic tail risk, again, different assets, different ranges, thresholds. But this one has been in the IYR real estate for safety since then. And then if you tuned into the live stream last week, I basically dedicated to Bitcoin. But I also trade on the side a Bitcoin strategy that is somewhat similar. And right now, this one is in fixed income for me, which has again been nice because Bitcoin has had a pretty rough go the last month or so. But that's tactical investing. And the payoff is this is our performance in the tactical volatility strategy since we moved to safety. So you can see what happens. Sometimes there's a few days of chop when the market is kind of figuring out what's going on. But because we exited to gold all the way back on February 21st, we've kind of just been watching this crash from the sidelines in safety. And you can see recently it has quite accelerated and the SVXY is down about 10%, but our strategy is down less than 1% because we were in safety gold. Defensive rotation, kind of the same thing. We exited to utilities and then to cash. And so no matter what happens going forward, let's say this 6% market crash that we've currently seen, what if this thing goes to 10 or 20%? Or maybe, like I said, hey, who knows, maybe this is the big one. It goes to 50%. Well, obviously this strategy is going to be just fine. Oh, I can see a little typo there. Forget about that. That should say defensive rotation, but it's actually only down less than 2%. Whereas the NASDAQ that we're actually trading, the QLD down about 10%. And then lastly, strategic tail risk, again, kind of the same thing. We cycled into safety, IYR real estate. This is a position that does perform much better than stocks when the volatility metrics are elevated. And this strategy is pretty flat, whereas the underlying S&P 500, since we moved into it February 24th, is actually down. We'll see what happens in the future. And then just really quickly, as far as the actual long volatility positions, like I said, these don't trigger very often. We very nearly got that signal there on March 6th, as you can see. If that were to have happened, this is what the strategic tail risk would actually look like today. Because of course, March 7th, the market was down again. Long volatility did very well, but I'm showing this to say that this is kind of what I'm talking about with tactical investing. We don't know when the market crash is coming, but when it does, there is absolutely an opportunity for profit. I'm currently sitting in a portfolio that's very safe, right? Iron condors are basically in cash, and then we're in gold, cash, and IYR real estate. If the market does crash from here, I'm expecting to do quite well going forward. But this is what I mean by tactical investing. And so why do we actually want to do this? Why would we tactically rotate to safety? Well, there's three main reasons, and the first one that I will highlight is what I call preserving emotional capital. Now, a lot of people are hyper-focused on their actual capital, their financial capital, the dollar value of their account, which obviously is very important. But what I mean by emotional capital is the more times in the market that you can avoid disaster and avoid making mistakes and avoid riding those drawdowns down, that's going to give you mental preparation to make better decisions in the moment. If you're that type of investor that is quite risky and you don't cycle out into safety, so you've had multiple big drawdowns in the past, it kind of gives you that PTSD, that shell shock thing where you really don't know what's going on, and it can definitely lead to you making very poor decisions in the moment. You'll think back to those times, well, I didn't exit this time and I lost so much money, and should I exit now? I don't really know what to do. Preserving your emotional capital by setting up a portfolio that doesn't give you those fears and those butterflies in your stomach, that you can kind of just sit in safety and actually feel comfortable. Like I said, right now, I don't feel scared about what's going to happen next week. Now, gun to my head, if I had to guess, I would imagine the market's probably going to recover from here. This might not be the end of the world, but the point is that I am preserving my emotional capital by not allowing myself to get into those trouble situations. This is very important. Don't overlook the mental game when investing. The second reason, of course, we do want to avoid the next major stock market crash. This should be top priority on everybody's mind right now in 2025. Like I said, we're only down 6%, but in the last 5 years alone, there's been multiple periods where it went 20%, 25, 34. Who knows if this 6 is going to double or triple? And of course, the big thing we worry about is what if this is one of those major recessions that's going to come? It's just a matter of time. We definitely need to avoid those because, as I always say, losses are more costly to a fund than gains are beneficial. If you suffer, say, a 20% drawdown, well, it's not the end of the world. It takes about 25% after that to get back to break even. But if you do suffer a 50% drawdown in an extended recession, it takes a full 100% just to get back to break even. And remember, in the dot-com bust, the NASDAQ index dropped 78%, which means it's nearly 400% away from breaking even. And we can see that on a chart. These are the three indexes. This is inflation adjusted, but the NASDAQ was down 78%, and it took 20 years to get back to the same point. The vast majority of investors out there right now were not investing before, say, 5 years ago. Most investors are new. That's kind of how it churns. There's certainly not that many who invested 10 or 15, 20 years ago. But the last 5 years might feel okay to you. But don't forget that the last 25 years, 20 of those years were just clawing back the previous drawdown. You don't want to be that person. Avoiding these crashes is your top priority. And then number 3, this is a big one, participate in the next great wealth transfer. Now, I'm going to do a full separate video this week talking about this point because of how important it is. But of course, it's awesome to participate in bull markets. We've done it as well. Our performance has been quite good. And for anybody with a little higher risk tolerance than me, you can see I have also, we've got the 4 strategies, total portfolio. This is what I trade. Full disclosure, I always trade the fully diversified portfolio, along with multiple other option strategies as well. But if you are a little bit more aggressive than me, you can go with just our top 2 strategies. But the point is, awesome. There's nothing wrong with trying to profit from bull markets, of course. Markets do trend up over time. You definitely want to participate in that. But the real value add, the point where you can accelerate your growth in relation to everybody everybody else. And like I said, participate in the massive wealth transfer. Those happen when you preserve your emotional capital, when you avoid the stock market crash, and when you have capital ready to go. At that point, a market crash isn't going to be scary for you. It's going to be the best opportunity of your life. You can make more money the year or two after a major recession happens than you probably can during a 10 or 15-year long bull market. If you know what you're doing, if you know how to tactically rotate into safety positions. This isn't something that's done on a whim. There are volatility metrics that can tell you when to do these things. Like I said, we are dividing the market up, and that's the whole game. Knowing when it is okay to be short volatility, knowing when you do have to cycle into safety, like we have the last couple of weeks into gold. And knowing when the time is right to strike to actually flip that switch and make money when everybody else in the market is losing. That's what tactical investing means. This is what I've been specializing in for all of these years. And I do believe now more than ever, this is the time to actually, like I said, we don't have to completely exit the market. If the market's going to go up for a few more years, awesome. We're going to be there to participate. But now would be the time to at least keep an eye on that exit door and make sure that your portfolio is bulletproof to the point that when it happens, because you're not going to know until you're in it, right? This isn't one of those things where you're just going to have a gut feeling and you're going to just time that thing perfectly. That's not going to happen. You have to have all of these rules and mechanisms in place ahead of time so that you're just following the process. So that's what I've set up for myself. I'm very confident that I'm going to get those signals. Yeah, there's going to be a little bit of whipsaw here and there, but we're going to get those signals. We're going to preserve capital, and I'm planning to thrive in the next market crash. So that's what I would recommend. Adopt this philosophy, and I think you're going to be just fine. So let's get into the next segment. Okay, so like I said, when volatility rises and the VIX gets into the 20s, like it is now, this is the time when there's going to be a million traders out there thinking that they're going to be the one to jump in there, play the contrarian game perfectly. They're going to short volatility, and they're going to make all the money when this volatility spike eventually fades. Because let's be honest, most of the time when volatility rises, the VIX gets into the 20s, it'll probably go back down. Right? This might not be the big final crash that we're waiting for. This could just be a small moment. But the thing I want to point out here, and I'm going to show a little test here, just be mindful that you actually still need your risk management. Because every now and then, things go from bad and then they go to worse. You don't want to step in front of that train, trust me. So what we're looking at here, this is the VIX index going back to March 26, 2004. That was the launch of VIX futures. Now, quick side note, this entire spreadsheet that has the volatility data, VIX futures data, all of the cash VIX term structure, all of the volatility ETPs going back to 2004, plus a bunch of other stuff, stocks, bonds, gold, crypto, Bitcoin data, inflation numbers, price calculators for the VXX. This entire spreadsheet can be downloaded. So all you have to do to get that, again, my live streams, I don't run them as some type of promotional thing, but just in case people want to know, if you do take the free 2-week trial to VTS, you immediately get access to our course library. And one of those will have your spreadsheet. So you just go in there, you can download your spreadsheet, and you will have that for yourself. But what we're looking at is the VIX index. Now, obviously, the VIX is a little bit elevated right now. The actual price today is 23.37, which you can see, that's about the 80th percentile, just about. So this is right around the time when people want to play the contrarian and come in and short the VXX. Or maybe even worse, short the UVXY or the UVIX, try to do this with some leverage. I just want to point out that that may not be a great idea. So you can see the highest VIX is 82.69. So I've made a little calculator here. If you just change this value here, it's going to show you what the short VXX return was using that as the threshold between short vol and cash. So if we use 82.69 and we go over here, you can see there's nothing. That's because it's the highest it's ever been, and there's never been a time when it's higher than 82.69. There's no trades. If we go back over here and we say 0, well, this means that you're short VXX on every single day. This is what it looks like if you short the VXX, daily rebalanced, going back to March 26, 2004. Now, the reason you daily rebalance, of course, is that when you short something, you can only ever make 100%. And shorting volatility, we want to do far better than making 100% over a 20-year period. That's terrible rate of return. So, of course, the way that traders do it, there's going to be multiple trades along the way. They're not just going to be buy and hold short. That's an awful idea. Now, probably it's not daily rebalanced. It'll probably be weekly or something like that. But it's the same general look. You want to be able to make sure that you can capitalize and make far, far more than just 100%. But if we look at these numbers, it's not great. The compound annual growth rate, 7.5. Most importantly, look at these drawdowns. So this is a 99% drawdown. This is a 92.5% drawdown. Obviously a complete non-starter. You have to avoid this. It's like I pointed out before. I mean, every little bit you ride down. I mean, if you're in the 90% drawdown range, it's going to take 900% for you to just get back to break even. Clearly, you want to stop doing this. So let's take a look at what it looks like with the current VIX right now at 2337. If we go over and see what it looks like, this is it. Now, I hope people can look at this and understand that playing the contrarian and shorting VXX when the VIX is in the 20s, yes, sometimes it works. Sometimes that contrarian ends up looking like a rock star. You can post your profit all over Twitter. Look at that. You timed it perfectly. But there are other times when the VIX getting to 23 is just the very beginning. And then what happens to you then? Well, you have an 85.5% drawdown or an 80% drawdown or a 70% drawdown or a 60%. There's been multiple drawdowns that are just devastating for traders. So this is what I'm talking about. Just because the VIX is elevated doesn't mean that it's the perfect short vol signal. I have no problem with people dipping a toe. I would definitely recommend you do it with defined risk option spreads. But the reason that I'm showing this segment is just telling you, be careful, right? And just for fun, just to mess around because it's open right now. Sometimes people might be thinking, oh, well, 23 isn't quite high enough. Let's wait till it gets to 30, right? Well, what happens at 30? That's even worse. This is not good at all. Now, of course, there's profit to be made after the VIX dips back down that level, but the point is, who cares? At that point, if you suffer an 80% drawdown, you're going to need to make 400% next year just to get back to break even. As an investor, you really don't want to spend years at a time simply clawing your way back from drawdowns because you made a mistake. We definitely have to cycle out into safety with our broad portfolio. And if you are trading option strategies or short volatility, you're doing those more aggressive positions, you also have to make sure that you don't make a huge mistake, suffer an 80% drawdown, and then you're not even going to be breaking even until 2029. This is not how you make progress with investing. Again, it's awesome to make a good rate of return in a bull market, but it's always more important to trim those losses during bear markets. That's the real game. So, VIX is 25 right now, 23. It's starting to feel like a fade. And like I said, gun to my head, I probably think the market's going to recover from here as well. But that doesn't mean that I'm going to just jump in there and say, I'm going to be the first one in. I always wait for confirmation of the signals. That's always based on my overall investing philosophy of using volatility metrics to get those systematic trade signals. So I don't have to use my gut instincts to know when this is going to happen. I just look at the math and I say, this is the highest probability of success. So I won't be stepping in front of this train, even though with a little bit of options, with a little bit of defined risk, yes, I have already positioned for some of those things. But now, as everybody's been waiting, grab a little coffee. We're going to hear from a word from our sponsor. And in 1 minute, we're going to do the open Q&A. So we'll get to the live Q&A in just a second here, but I launched VTS all the way back in January 2012 with two main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Now, our portfolio is currently 4 strategies with low correlation to the stock market and to each other, so it's a completely diversified total portfolio solution. It's also not active day trading, and trust me, anybody from any background can follow VTS in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for over 20 years now, and I share a lot of invaluable volatility data in every daily email to subscribers. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS on my website available to everybody. Come join members from over 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay, so I can definitely see that there are quite a few questions already. I'm sure more will come in. And like I said in my first post, we're just going to pretend I knew that daylight savings was there, and we're just going to gloss through it. So I think the reason that I was going to do that, I don't know if people know this, I've mentioned it a lot, but probably only about 5 or 10% of the views that come to my live streams are actually live, which is great. I appreciate everybody coming live, but I do have to do a little bit better job, certainly in the first, say, 20 minutes or so, to really get to the point quickly so that it's a better viewing experience for people who come in after that. But once we get to the open Q&A, from here, it's just kind of chilling out with everybody, answering as many questions as I can. So let's actually get into that. First 10 or 15 look like it's about daylight savings. Apologies. Here's one. Here's a good one. This one actually comes up quite a bit. Will there ever be a VTS ETF? Wouldn't that also be a lot easier for you since you don't have to spend any time creating courses and possibly reach more investors? So this is a really good question. The second part there, I actually don't mind creating the courses and doing all the educational stuff, live streams and whatnot. You're probably right that the ETF would minimize most of that. And to be perfectly honest, regulatory-wise, it would probably maybe handcuff me a little bit. I'm never really the type that's always out there pumping performance numbers. If you go on my Twitter account, you'll almost never see me mention, any type of stuff like that. I'm not one of those, services. And I'm also never, recommending trades on Twitter like, hey, we're going to do this. So I don't know regulatory wise, but I actually like doing the education stuff. I think it's great. It keeps me busy. I'm proud of the work that I put out. I do it basically because I'm just trying to help people become better investors. I could probably revamp my marketing schemes and make them far more direct to just getting people to subscribe. But I decided many years ago that I'm going to manage this for me, for fun, for the community, and I'm not going to ever, I don't know what you would say, like sell out to that type of subscription service vibe. So the ETF, I hope it wouldn't put a complete stop to the courses. But to get to the honest question, yes, this is probably something that I will at the very least look into. I definitely want to get the options course back up and running. We used to have both the VTS and the VTS options, and people were happy. But I was a little bit inadequate in the explanations, and it caused problems. So project number 1 is to get options back online. And then once we've got both going again, then at that point, I can look to take on my next major project. And who knows, it might be that. Another thing that I could consider, I'm just spitballing, we're on a live stream, but people might not know this, but I am a fully registered portfolio manager as well. I could, go back to Canada. I've done all the certifications, like 6 or 7 levels. I could basically go back and start my own RIA. But another thing that I could possibly do is maybe act as a consultant and find ways here and there where people can work with advisors to trade my strategies. So that might be a project that I would take on as well. Kind of kicking around ideas here, but yes, you're not wrong. It would, if I wanted it to, it could definitely streamline and eliminate a lot of my day-to-day work. But like I said, I really like doing this kind of thing. Hopefully that comes across. Like hopefully people know that I don't really have to do this stuff. But yeah, so even if I did an ETF, I'd like to do it in a way that maybe keeps me at a distance so I could actually still pop on YouTube and answer questions and whatnot. I know a lot of people, financial advisors on Twitter, they're all like everything they say, they're like, oh, this isn't financial advice and, go consult a financial professional. I don't want to be that guy. I just want to talk. I just want to say what I think and, it is what it is. All right. And another question. Do you use any alternative data for your strategies, or do you even record special data yourself? So not sure what you mean by alternative data. The data that I do use, some of it you would recognize. Like this is from the daily email, of course. If you're a subscriber, you know all this. Some of this stuff you will be familiar with, right? Some of these are metrics that I've designed, and some of the metrics I just care not to share because I do have a couple that are really unique, and I kind of want to keep some of the things just strictly to myself. But some of these things are calculated on my end that you wouldn't know what they are. But maybe that's what you mean. And yes, I do use my own calculations, my own metrics that I've used. That's a combination of multiple different things. I look at things like that, like the cash VIX term structure. This is all public data, but the way that I use it specifically to my strategies, that would not be public at all. Like all the momentum indicators and the changing values from day to day, that's all designed by me behind the scenes. So, look, I guess what I would say is the basic underlying data you can get, everybody can get the VIX futures. I even have a spreadsheet you can download for free. It's VIX futures, VIX index, volatility risk premium implied, historical volatilities, all the basic stuff is there. It's how you use them, how you translate a set of data into an actionable trade signal. I think that's kind of the secret recipe, so to speak, of VTS. And I think you can understand why I don't just come out and share that publicly. Don't make me say it. All right. I hope the market collapses. I've jumped ship. I am just in individual stocks and heavy tempted on shorting the market. So if you are just in individual stocks, not to nitpick too much, but aren't you even more exposed to the market than if you were just in indexes and tactically rotating? Like I pointed out, there it is. Like I pointed out in the presentation, I am also thinking that at some point there is going to be major problems in this market. But that doesn't mean that I have to go to the sidelines today because I think in the next year or 2 or 3 years, there might be a major market crash. I can just continue trading as I always do, knowing that I'm going to get both sides of this. If the market turns out to be really good in the next 3 or 4 years, I'm going to make money off that. If the market happens to decide on its own that it's going to go into an epic collapse, I'm also going to make money on that. So what I would say is, kind of towards the presentation, what I said, the reason that we do what we do is so that I don't have to make those decisions. Because I know that if it's left up to me to decide when is the right moment to strike and flip the switch and short the market, I'm almost certainly going to get that timing wrong. If I just use my own gut instincts, and not just me, but everybody watching, you are all probably going to get that timing wrong. We don't know when the market's going to crash. And like I said, you won't know it until you're in it. So, I understand it's your money. You do whatever you want. But the reason that I've designed my strategies the way that I do is so that I don't have to do what you're saying here. I don't have to just say, feels like it's time. I feel like maybe I should get out of the market. Maybe I should even start shorting. I don't know. I'll just get the signals on that day. The strategies have systematic rules. It'll tell me, go into long volatility. And I will wake up in the morning and I will move into long volatility. And I won't know if that's going to work out. But the system says the odds-on favorite are when volatility is elevated, that's when you can actually take that chance. So it is what it is. I've got a long-term experience knowing that as often as possible, I should take the decision-making process out of my gut and put it into the mathematical signals. I think that's just, people are better off doing that. Now, some of my option trading is entirely discretionary. Some of it is partially discretionary. But yeah, I do like to remove that guessing game whenever possible. Total Dentistry. When did you start doing a Bitcoin tactical trading strategy? Do you send an email out for that? So I did I did a live stream last week, and I talked mostly about Bitcoin. We don't talk about Bitcoin very often within my community because we don't really trade Bitcoin within the VTS portfolio. And I don't think that's going to change. Bitcoin is leveraged equities. That's all it is. If you watch the live stream from last week, I showed a chart with the leveraged equities versus Bitcoin. It's tracking unbelievably close. Let me see. I have closed a lot of my desktop here, but if you just bear with me, I'm moving things around. Here it is. Can you see that? I moved a bunch of stuff, so I'm not even sure. You can't see it. You just see my mouse moving around. But yeah, you can see this chart here. Bitcoin is essentially leveraged equities. I know a lot of people feel, and I don't say this to insult people. Look, trade what you want to trade. It's fine. But A lot of people who trade crypto, they just feel like they're part of this great movement where they're the ones that are in the know. They're the ones that are fighting the elites. They're the ones that are protecting the little guy out there. They're the ones that are fighting against the banks and they're anti-fiat, all this stuff. Relax. You're leveraged equities. That's really all you're doing with crypto. It is just another risk-on speculative asset class. No more, no less. I hope people are not overly insulted by that, but literally just look at the numbers. I beg you, if you're in crypto and you're one of these people that's saying you got to sell your house because this is the future and it's okay, but ask yourself the simple question. If you're so confident in your Bitcoin investment, would you sell Bitcoin today and put the exact same amount of money into triple leverage stocks? I would imagine the answer from 100% of everybody who's asked that is, are you out of your mind? Of course I wouldn't put all my money in leveraged stocks. That's crazy. Well, I hate to break it to you, but that's what you've done. So this is all a sort of roundabout way of saying, no, I don't see any reason, because we already trade leveraged equities, I don't see any reason to stuff more risk on speculative assets into my broad portfolio. It just doesn't make a whole lot of sense. It's fun. And yeah, I do this on my own, and I've been doing this for roughly a year and a half, give or take. Roughly 2.5 years ago, I jumped into Bitcoin for the first time. I bought 2 Bitcoins in June of 2022. I have recently sold the last one. So I am out of the buy and hold game forever now. I just am going to be a tactical investor, and I'm going to use this strategy plus a bunch of option strategies to do my Bitcoin trading. And I will maybe find a way to give those signals to people. It might be through some type of alternative free newsletter, maybe just upload them on Twitter. I don't know how I'm going to do it yet, but no, it's not going to be part of the portfolio, because in order for me to add something to my portfolio, it has to have a very specific purpose. And adding anything to do with crypto to a portfolio that already trades leveraged equities and short volatility, well, I'm just piling on the leverage, aren't I? They're all exactly correlated, aren't they? What's the difference between just leveraged NASDAQ? It's the same thing. So again, sorry to hurt the people's feelings who do hold Bitcoin and do feel like they're part of that secret society of, whatever they feel that they're invested in. The story, there's not much of a story. The more mainstream it gets, the more banks that do this, the more ETFs that pop up, this thing is going to behave exactly like leveraged equities. That's just what's going to happen. So it's one of those things, be careful what you wish for, right? The Bitcoin people were always talking about how it's a store of value, it's a hedge against inflation, it's all these things. Yeah, maybe 7 years ago, but now it is a mainstream asset class. For the last 4 years, more than 4 years, it's basically tick for tick leveraged equities. Don't be surprised if it behaves exactly how BlackRock and all the big banks are wanting it to behave. It's going up because it's in those investor portfolios. It's not an inflation hedge. It's literally the most risk-on leveraged asset. So what's the point of stuffing it into my portfolio? Destroyed all the hopes and dreams of all the Bitcoin people out there. I'm not against it. Like I think there's a time and a place to do risky investing. It's fine. But just, like I said, just as a general health and safety check in your portfolio, just to see that you didn't actually leverage your house to buy Bitcoin, just in case you didn't actually max out your credit card to buy Bitcoin, just ask yourself the inverse question. Would I do the same thing with leveraged equities? I would imagine the answer is an immediate hell no. And that's your answer. That's what you need to know. Well, if the answer is hell no, I'm not going to buy and hold the TQQQ, knowing that it's going to have a 90% drawdown, well, that's your answer. You wake up tomorrow and you start finding ways to trim down your crypto portfolio because you are way, way over leveraged. It's a pretty good test, right? It's a pretty good litmus test. People don't know they're leveraged equities at that extreme, but they are. Do I ever trade the VIX futures? No, not within our community and not for any of my private trading at all. In fact, I don't really do a whole lot with futures. I think it's just, there's nothing wrong with it. And in fact, there are certain situations where you could say it's just as good or better. There's certainly some tax advantages in certain areas, but it's a whole nother level of people getting permissions and IRA accounts and, understanding the education behind it. It's just, you don't need it. ETFs and options can do absolutely everything. You don't have to go to that level. Also, the volatility ETPs themselves, aside from some bumps along the way where they sort of decouple from their underlying indicative values, it occasionally happens, but more than not, they track extremely well to the VIX futures anyway. So why would I need to go in there and build the product myself with the futures when the volatility products are already tracking really well? And they're designed well. They do what I want it to do, right? I want something that is predictable, that we can use signals for, but also has significant drawdowns, so that if I focus on trimming those, I can actually make a much better rate of return. Like I said, I think last week or something, somebody asked a similar question. I don't think I could trade a bond ETF and beat the underlying bonds. That would be very difficult to do, because where are you going to make your outperformance? I guess you could leverage at certain times, but the best way to make a good rate of return is to cut the drawdowns. So what we're actually looking for is asset classes that do have significant drawdowns. We can trim those and we can actually make more money. Now, the follow-up question would be, well, why don't you just do triple leveraged across the board? Well, that's because sometimes you do wake up the next day and you just get gut kicked. You can't see it coming. So you have to be in an asset class that does have extended drawdowns, but not extreme single day drawdowns. You don't want to do something like triple leveraged stocks where you get the timing wrong. Maybe last Friday, everything's perfect. And then over the weekend, Trump says something horrible. And on Monday, you wake up and you're just devastated, right? You've got to trade. You got to balance that line between, we want a little bit of risk, but we don't want the huge, huge problems. So, micro strategies and stuff like that, it's just way too much. You're going to get those days where you just can't believe how much money you lost and you couldn't have seen it coming. You've got to get out of assets that do that to your portfolio. Some chop up and down is good. Too much is uncontrollable. Was that even your question? That felt like an off-topic rant. I'll try to keep those to a minimum. Okay. Do you take the gamma exposure into consideration when trading options? If possible and if useful, could you explain this concept in more detail? Thank you very much. So not really. Gamma is one of the things that you just have to generally understand what it is. You don't have to calculate it, and you don't specifically target it with any of your strategies. So all gamma is, the explanation of gamma kind of requires you to already know what delta is, but which is kind of cheating a little bit. But let's start with delta. Delta is a first order Greek that measures the expected change of an option's value given a $1 change in the underlying. So let's say the delta is 0.5. It essentially means that if the underlying stock or ETF moves by $1, your option contract will change value expected, all other things held constant, right? Nothing else changes in the market. All other things held constant, you are expecting your option to change by 50 cents. That's essentially what delta means. Gamma is the second order Greek of delta, which measures how much your option contract will change given changes in delta. So it's a second order Greek. So don't worry about the math. You don't have to know math to be a good option trader. But gamma is essentially measuring your day-to-day risk given how much the underlying is moving. So the only thing you really have to understand is that gamma, like we trade iron condors, for example, gamma is lower with longer dated contracts, which benefits you. It means that if you get caught in an unexpected drawdown, it doesn't hurt a longer dated contract nearly as much as it would a short one. Because if it's only got 5 days to go, delta's high, gamma's high, this is a problem. But if you've got 30 days to go, the gamma exposure on that delta is much lower, so you can control your risk. So that's all a roundabout way of saying gamma is essentially just a measure of essentially the convexity of market movements of the delta. And no, you don't have to take it too much into consideration. I could say, I could make videos and say, well, talk about the gamma and stuff like that. I prefer to just say, keep your contracts longer dated because they're safer, right? I don't want to geek it up and sound like I'm on some type of mathematical pedestal or something. So just understand what gamma means. Keep your gamma exposure low if you can. This is why sometimes you will hear me say, shorter dated contracts, you are dancing on the gamma knife edge. The reason I say that is short dated contracts, Delta moves $1, you might be okay. It moves $2, you might be hurt. It moves $3, you're going to get devastated because that gamma is measuring the order changes of the delta. So just keep that in mind that if your gamma levels are high, your market signals and your market timing has to be exceptional. Otherwise, you're opening yourself up to a lot of risk. It looks like I missed one. And I have to go back to it because if I skip that question, people are going to think I'm dodging. And I don't dodge questions. I'm not afraid to speak my mind. There we go. Tune out if you don't care. Do you think Trump is on the right trajectory regarding the U.S. government deficit? So here's another one on Trump. Maybe I'll just highlight them both. My thinking on Trump, he is obsessed by commercial balance, going to try to vilify the dollar and chop debt interest. John Doe, going to take heavy inflation tax chop like UK in the 90s. So what do I think of Trump? Well, first of all, I have to say it outright. I have no allegiance to any political party or any politician in particular. I always say I'm an equal opportunity offender. I hate them all. They're all out for themselves. They're all doing everything. Like every single decision that is being made by the government is being made on behalf of the top 0.1%. You just have to know that from the start. It's a marketing campaign to make people think that they're doing it for the benefit of we the people. No, they're not. The president, he makes $400,000 or $500,000 or whatever it is. Donald Trump has been literally handed checks for hundreds of millions of dollars. I think just Adelson alone was like $300 million. You have to understand that in a world where the people, we can only through tax dollars, we can only afford to pay congressmen $200,000. We can only afford to pay the president $500,000. The 0.1%ers of the world can literally pay them tens and hundreds of millions of dollars. This is why everybody's like, this guy's a congressman. He makes $178,000 a year. Why is he worth $50 million? Well, why do you think, right? He could quit his job in Congress tomorrow and get a job in the private sector for $10 million just like that, anytime he wants. So, of course, that they're in the government knowing that the private sector and the ultra rich can pay them far more money than we the people can. So this is not a knock on Trump specifically. This is all politicians, including Sleepy Joe Biden, including what are all the names of these people he named, whatever Pelosi's name is, whatever Chuck Schumer's name is. Pick your guy on both red or blue teams. Unfortunately, they work for the ultra rich. That's what they do. So is he on the right track? Who are you asking? Like, yeah, he's on the right track. If you're talking about, like, if you're in the top 1%, he's on the right track. Like, that's what Elon and Trump are doing right now. They're in there to deregulate the government, deregulate all the economy so that they can come in and fleece the economy. It's the same thing the blue team does whenever they're in power. It's the same thing that Obama was up to. It's the same thing that George Bush was up to. These guys are ultra, ultra rich, and they rub shoulders with the ultra, ultra rich. It's just a marketing campaign saying that it's for us. It's not for us. I know it's not for me. I know I have to take care of my own interests. I have to make my own money. I have to save my own retirement. These people, they're not working for me. They might say they are. They might say all the right things on Twitter. It might sound really cool. No, it's not for us. So is he on the right track to cut the deficit? No, it's just going to continue to rise. Let me see if I have a chart of that. I seem to have charts for almost everything. Probably have a chart somewhere for that. Got to move some things around here. There we go. How about we take a look at this? Let's mark the day. You guys can come back if you're... Sorry, bear with me. If you think I'm being overly harsh saying that they're just working for the billionaires, let's see. So here's the mark of the U.S. deficit, and we can come back in 4 years and you can let me know if this number gets larger or smaller. I tend to think it's going to go a whole lot higher. I tend to think all of these Doge cuts and whatnot, call me a pessimist, whatever you want. I just think it's mostly to just switch the contracts out between, switch out Verizon, sub in SpaceX, switch out military contracts, sub in Tesla. Nothing wrong with that, I suppose. They've always kind of done this. Like I said, I'm not saying this to any particular party or any particular person. I hate them all. Oh, that's a strong word. I don't hate them all. I understand them all. They work for the billionaires because they are billionaires and they all want to be billionaires. And if they all work together, they will all be billionaires. Like the wealth gap is going to be just unbelievably big at the end of the next 5 years. So, take all that for what you can. But like I always say, they do an exceptional job marketing to make people think like red team and blue team are different. And they control the media. The media does a really good job making all of us think that it's black versus white, it's red versus blue, it's, these people versus those people. It's not. It's always been rich versus poor. That's the game. And the more they can get us hating each other, the more blue team they can get fighting the red team, the less time they spend merging together and making sure that the elites actually pay a little bit. But they're winning and they're going to win. Billionaires are smarter than politicians. They're more efficient. They get things done. It is what it is. Your government currently now is looking like it's pretty heavily skewed towards the billionaire class, and they're good at this. They're very, very good at this. They've been honing the skill of transferring wealth from our pockets to theirs for 30, 40 years. So this is not good. Not good for the regular people, but it's going to be very good for them. So I think I posted on Twitter maybe just yesterday. If you're in the top 1% in the U.S., congratulations. If you're not, that country might not be for you anymore because it's going to be bonkers how big this wealth gap gets. I think people are going to be surprised. They're going to turn around and go, wait a second. This isn't exactly what I signed up for, but it is what it is. So there you go. Good thing I did that whole political rant, a good 40 minutes into the live stream. So a lot of people, they can probably leave or whatnot. But I will answer political questions. You might not like my answers, but I speak my mind. Okay. Not stock vol related. Okay, that's fine. If one was a Canadian living in Canada and successfully at trading full time, where would be the best jurisdiction to optimize for taxes to relocate? Come join me in Dubai. It's perfect, right? There is tax now, but it's 9% maximum corporate tax. There's a lot of exemptions, and it doesn't really kick in until 2026. So, yeah, it's not difficult at all to get residency in Dubai and pay zero taxes. You're a Canadian, which is great. They don't tax overseas income. So if you just leave Canada and you do all the right things, you check all the boxes of becoming a non-resident, then you're good to go. You can just get your taxes down to zero or near zero, and you can live in a beautiful place like Dubai. And the benefit is, it's not like you have to leave Canada. You can live in Dubai for 6-7 months a year, and you can live in Canada for 5 months a year if you like where you live or if you have family or friends there. You don't have to do it permanently. But Canada's good for that. The U.S., not so much. U.S. taxes all income all over the world. You can't escape it unless you give up your citizenship, which I don't know if people are ever really willing to do. And I don't think I would ever recommend people do that. So, yeah, Canadian, Dubai. Or Abu Dhabi if you want to. We say Dubai, we basically just mean that whole area. And maybe Saudi soon. Maybe 5 or 10 years from now, Saudi will be ready. Okay, I have tried to short the VIX with call spreads, but there's not enough premium. Why? Well, that's kind of a relative term, isn't it? Not enough compared to what? Options trading is pretty simple when you reduce it down to, it's not about always being short. It's just about selling things that are expensive and buying things that are cheap, right? Premium that is cheap. So it's sort of up to you and your trading models and your analysis of the market to determine how much premium is enough. It sounds to me like you've decided that if I'm going to be taking on the risk here, it doesn't seem like these contracts are paying me enough. That's your answer. Don't open the contract. Look for something that has a better risk reward on the premium side. Right now, why is it not paying enough? I don't know. Everybody's pricing model is going to be different. I tend to think you're a little worried that maybe the market gets a whole lot worse and you're not willing to take on that risk. There are other people who might look at the exact same contracts with the same strikes and everything and think, I can't believe they're paying me this much. I'll sell this VIX call spread all day long at that premium. There's no way it's going to go higher than that. Other people might say that. So it's up to your pricing model. It sounds like you've decided that it's not worth the risk, which is great. Trade what you know. Would you sell your intellectual property to an ETF company if you don't want to start a fund yet? Are you buying? Put your offers on the table. Let me know. I tend to say no, but some people don't know this, but I actually have another consulting firm. It's called Prosperitas Asset Management, where I do actually consult and license strategies and whatnot. So there has been several hedge funds, family offices that have actually purchased my strategies as well. And then part of the deal is that I do some marketing material and I can put together some packages and whatnot. So I've done some things like that in the past, but yeah. What's your offer? Alternative data like credit card payment data and satellite imagery. No. Satellite imagery. I don't even know what that would mean for the stocks, but no, I don't do anything beyond. And I'm quite hyper-specific to volatility metrics within the overarching S&P 500 volatility complex, right? People sometimes ask me, do I use bond volatility metrics? Do I use other metric? No. I want to make sure, because the S&P complex and the whole volatility complex surrounding the stock market is, in my opinion, where all the decisions are being made. I do feel like bonds, for example, it's not an active position for anybody. Nobody buys and sells bonds because I wouldn't say nobody, but it's not one of those things that they're entering and exiting because of the bonds. It's kind of a default position. Like, I don't want to be in stocks, so now I'm in bonds. Or I need X percent of my portfolio in something safer, so there it is in bonds. There's not a whole lot of active decision-making happening. But in the stock market, that's where all the active decisions are being made. It's kind of like, if I can draw it back to our portfolio, it's kind of like when we are in gold in our tactical volatility strategy, it's not because I'm bullish gold. It has nothing to do with an analysis of gold. It's simply because I've decided that I'm not going to be in short volatility and it's too early to be long volatility. So I'm basically parking money in gold, but it's not an active portfolio allocation towards gold. And so that's what I would say about all of the other so-called alternative data sources. Everything I do is hyper-specific to where I think the largest institutions with the most capital running through the markets is the decision-making process. So like you said, what did you say, credit card stuff? I'm not saying there might be useful something to learn in that data, but I wouldn't say that the bulk of BlackRock clients are buying and selling anything based on any of those numbers. So this is why I don't do any seasonality. I don't do any, bond index, volatility index stuff. I think you get the point. I like to keep it hyper-specific to stock market, VIX, VIX futures, things like that. What do you think about SVIX, SVXY recovery? How long it may take? It's an interesting question. Let's take a look at where we're at. So we've got the SVXY, for example, and right now, what is it at? It's 45, it's down significantly. So how long would this take? Well, if the market recovers and hasn't just an exceptional year or two, it might recover then. So this could take 6 months to a year under ideal perfect conditions. Let's look at SVIX. SVIX is down well over 50% at this point. So how long would this take? again, getting back to the charts of drawdown recovery, the lower it goes, the longer it's going to take to recover. So if this goes on a whole lot longer, you could be looking at a situation where SVIX, SVXY, inverse volatility ETFs, they might not break even for a number of years. That could definitely happen. And then if there's a recession in that middle ground, then all bets are off. It could take 5 years after that, 6, 7, 10 years, whatever it is. So yeah, the key is, do we really care? Like, I'm not down. SVIX is down 60%. We're at all-time highs in our strategy. I don't really care that the SVXY is down. I've spent over half of my time in gold in the last year. So yes, the SVXY has been crashing, but since July of last year, I've been in mostly gold, which is actually, it's done pretty well if you can see. I don't really care that the SVXY is part of my strategy and it's done very, very poorly. I wasn't in it when it cratered down like this. We exited on July 24th, which is right there. We exited right near the top. We didn't go down that far, and we went into gold, which you can see gold on July 24th is like right there. So we've been in mostly gold. We've been in a little bit of SVXY. This is a long way of saying these products, short volatility, they will have 90% drawdowns or more. That doesn't mean that our strategy is going to have a 90% drawdown. We could actually make money if that thing has a 90% drawdown, because we can actually go long volatility. I hope it has a 90% drawdown. That would be amazing. But we just trade what the market gives us. Just utilizing safety, utilizing tactical investing. My whole point in that introductory segment, I don't want to make those decisions. Maybe it's fun to try to guess when this is going to happen, but it doesn't matter. It doesn't matter at all for my bank account. So it's just fun, right? It's just talking, exchanging ideas. I plan to keep my strategies as close to all-time highs, regardless of what the underlying indexes do. And we can do that because we've got multiple different positions we can utilize. SVIX is dead. It's going to go to zero long term. The markets are just too volatile, causing it to lose value, especially with Trump. I mean, zero, that's obviously a little too extreme, but I get what you're saying, because these products, the more choppy the market is, the more it's going to decouple from the stock market. This is one lesson that I can sort of take this question and actually teach something here. A lot of people are under the impression that volatility ETPs are essentially just proxies of the stock market. They think that, well, if I'm bullish on the stock market and my signals are positive for the stock market, well, that means I could either buy the S&P 500 or I could buy SVXY or SVIX. It's the same thing, right? They're a proxy. Or you could, don't do this, we don't short unlimited loss, but we could short the VXX, short the UVXY. These people think this is just a proxy position. It is not. There's a correlation there. It's about 70% correlated, but there's plenty of times where it decouples. And, spoiler alert, we are in one right now where, yes, the SPY is down a little bit. It's down about 6%. It was down maybe 7% at the lows, 7 or maybe even 8. I didn't check exactly. But obviously that has majorly decoupled from the short vol trade. Now, you have to understand that the opposite is also true. There are times when the stock market struggles and the short vol trade crushes it. Stock market can flatline for 6 months straight, and those VIX futures continue to decay and expire. They go down, they decay, they drop off the board. M1 goes to M2, M2 goes to M3, and the whole thing moves down. There are periods when it decouples the good way, and that's why you want to always make sure that you have a diversified portfolio. In the last 4 or 5 years, our defensive rotation strategy is doing a lot of heavy lifting for us. It's by far the best strategy we've got going in our portfolio. But there have been times in the past where it's actually tactical volatility that has been crushing it for us. There were times, in fact, 2022, for example, when iron condors was the standout. In 2022, all 3 of these were down, and down significantly. 2022 was a rough year. Iron condors were up 26% in 2022. So, long way of saying, Volatility ETPs and the stock market have a correlation, but they are not the same thing. I know you don't think that they are. I just thought that that might be a useful thing to say. Now, as far as it going to zero, no, it's not going to go to zero, because at the end of the day, markets trend up, VIX futures do decay downward. So there's always going to be that trend where if it just has a 6-month or a year stability period, it can actually make up a lot of ground. And so long term, the SVIX long-term compound annual growth rate since 2004, if you simulate the prices going back, it's about 12% a year, and with 90% drawdowns. So that's typically what's happening. Yes, it will probably continue to make 10 to 12% a year going forward, long term. Some years it'll get devastated, other years it'll do great, but it's going to trend upwards. So I don't disagree with your underlying premise that under Trump, under the whipsaw environment, it could just steadily bleed and whipsaw. It's not going to zero. It's an inverse vol product. Those VIX futures are always going down the curve. How do you think your strategies would perform in a long sideways market like 1930 to 1950 or 2001 to 2010? 1930 to 1950, I would not call a sideways market. I would call it a market that had extremely strong trends in both directions. So in that type of environment, I would expect to do just fine. 2001 to 2010, let's narrow that down further, because obviously 2001, 2002, I would have made a fortune, right? We would have been long volatility. Volatility, once it elevates, we're going to move into the safety and long vol, and something like the dot-com bust would be a blessing in disguise, right? It would be pretty good. So the worst year that I can imagine for my strategy specifically, and probably, to be honest, for everybody out there, from about February 2007 up until September 2008, when Lehman Brothers finally collapsed and the whole market caved, that sort of 18-month period would have probably been, and again, I wasn't live trading these strategies then, but I know how they behave, and that environment would have been a problem. A lot of people don't really remember that or don't know that, but the S&P 500 was down about 18% before Lehman collapsed. It was down for over a year. It was in a drawdown before the financial crisis even happened. That market would have been very, very difficult. I would say the other extremely difficult market, not difficult, but it would have been frustrating for someone like me, 97 to 2000, before the dot-com. Like I said, once the dot-com bust started to pick up steam, I would have made everything back like 5 times over again. But 97 to 2000 would have been a tough year because, again, people don't look at data too far back. They might not know this. But 97 to 2000, the stock market's doing very well, but the VIX index and volatility metrics were in the mid-20s. It was just a very strange market where people have to remember that volatility is not directional. It doesn't mean markets are doing well, so volatility is low. Volatility means variation from the mean. So if you have a market environment that's doing exceptionally well, like leading up to the dot-com bust, that volatility can push the VIX to 25 because it's changing value quickly. It doesn't say it has to be up or down. It just says volatility, right? So it would have been hard for me to pick up the right signals in an environment where volatility metrics themselves were telling me to be in safety, but the true best position would have been long equities. That would have been frustrating. Think of a couple more. I mean, obviously 2022 was frustrating for an entirely different reason. Our signals worked just fine in 2022. The problem is the safety positions themselves also crashed just as much as the stock market. So what good was it to get the right signal to move out of stocks and into XLU if XLU was down just as much as stocks? What's the point of moving into real estate if it's also down 30%? Bonds were down 50. Fortunately, we were not in bonds. So every market environment that was troublesome is for a different reason. But I would say in general, 2007 would be the hardest I can imagine. 2022, again, like, look, if gold, real estate, and utilities don't perform better than stocks, then my strategies will track stocks. And if it's a 20% drawdown, I lost 20% in 2022. That's just what happens. There are some tough environments. You can't have I know it would be amazing if you could just have a portfolio that was bulletproof and made money in every single market environment, no matter what. Wouldn't that be awesome? It's not the reality. The reality is there are going to be things that test even the best strategies, even the best portfolio. You're going to have periods of underperformance. Even the great Warren Buffett had 50% or more drawdowns multiple times. And it is what it is, you know? Why did you stop sending signals for 0% volatility trend overlay? Do you feel it's too risky? No, but for this one, I think it's just better if I just direct you to a proper explanation, just because I don't want to drag down with an explanation that I've already done. So if you go to my blog and you go to the articles, it probably isn't even that long ago. Volatility trend, regime change. I knew this would happen. Whenever I do this on my live streams, I can't remember what I labeled my articles, but it's in here. You'll see it. It'll pop right out I hope it does. I hope I didn't label it like an idiot, that the title has nothing to do with the article. This is frustrating. All I will say is there is an article here. Well, that was a total whiff. There's an article on the website, probably on page 4 or so, that is going to be labeled something like volatility trend strategies being removed from the portfolio. Essentially, I love it. The community didn't love it so much. That's probably because I wasn't very good at explaining it. So what I've decided to do, remove it from the portfolio so my emails stop blowing up and people ask the same question over and over again. And I'm just going to make a course and I'm going to stuff it into the VTS Options Academy when I get around to doing that. That way there's going to be, 5 or 10 really good explanation videos underneath it. And when people understand what it is, I think they'll start to really like it. The problem is when it was just one of 5 strategies, you can imagine I can't dedicate all my time to explaining one of the strategies. So it didn't actually get that much love. I didn't actually do it justice in the explanations. So it's out. I still trade it on my own, and it will make a reappearance at some point in the future somewhere else. What's the time? We're already over an hour. Remember I said this year I'm going to really try to stick to the 1 hour. So we're going to leave it. I'm going to answer one more, but we're going to leave the flow of these questions here at this one. And I'm going to just quickly scroll through and I'm going to pick one that seems to jump out at me. Oh no, we left off with this one. Okay, let's do one more question. Let's try to get one that's a little bit more interesting or a little bit spicy. Let's try to get me canceled somehow. Yeah. Okay, what are we looking at? There's a ton of questions. This is natural. This is fine. It's good. I appreciate everybody coming. Obviously, smash the like button. There's way more people than likes, so we should get those likes up, please. But I am at the point in my live streams where there's just no way that I can continue answering every question. So I'm going to do it in an order and just take a mental note for next week's live stream. Get your question in early, and that will guarantee that I actually answer it. Okay. Spicy. I agree with your views on politicians. They're more interested in saving their job than doing their job. I think it's more than that. I think you just have to think about it rationally. I'm detached from the emotions when I say that Trump is serving the billionaires. I'm not anti-Trump. In fact, I did live streams saying that, gun to my head, if I was a U.S. voter, I probably would have voted for Trump. I'm not anti-Trump when I say this. I'm just a rational human being. The U.S. taxpayers can only pay this guy a paltry little salary. The billionaires that he hangs out with every day can literally change. Like, Trump made more money in one day with his crypto rug pull than he made his entire life as a businessman. 78 years on the planet, and his net worth was $3 billion. Great, right? Obviously, a lot of that was inherited by his dad, who was ultra successful, but beside the point. Up to $3 billion net worth. He's a billionaire. Good for him. And then one day before inauguration, now he's worth $10 billion, right? The U.S. taxpayer can't do that for Trump. The U.S. taxpayer can't change Elon Musk's future. And let's throw in some blue team just so people don't think that I'm, being partisan here. Nancy Pelosi doesn't care about her $178,000 income. She'll give it up. It doesn't matter. That's a can of Coke to her. It doesn't matter. She's there to get stupid rich. That's why they're there. And they can't do that by me. My tax dollars can't do that for them. So of course they serve the billionaire class. Of course they do. That's the whole point of lobbying is, lobby groups and billionaires can give a lot more money than the U.S. taxpayer can. It's just obvious. So again, don't think that I'm despising individual people or people from a certain color political party. Equal opportunity offender. They're all out to screw us. And I can't say for sure what I would do in that position, because by the time a human being goes through the ranks and either achieves a high political office or achieves billionaire status, the range and the leniency of your ethics on that lead up probably turn you into a different person by the time you get there. So you're wide-eyed and idealistic on day one when you go to Washington, D.C., and I'm going to change the world and I'm going to fight for the little guy. I'm sure that a lot of them probably started that way. They probably did. I don't think they're bad people. I think most billionaires probably didn't start out being so just being like puppet masters and controlling the strings and doing all these weird things that some of them seem to be into. I'm sure they started out as nice, cool, regular people when they were in their 20s. But by the time you get to that level, you're a different person, right? I'm not a billionaire. I'm never going to be not even, that's ridiculous. And I'm not a politician. I'm never going to be one. In order to get elected a politician, I would already have to demonstrate that my ethics are on sale. So, yeah, I just look at the world rationally. As I always say, don't trade the market you want. Trade the market you actually have. It's the same with politicians. Don't look at the political environment with ideals and this is what I think that guy's doing because he posted it on Twitter that he's trying to help us. No. Just rationally. No. They don't care. And why would they care? There's nothing that they can do for us. Even if they did fix all that stuff, we'd probably just find other things to complain about anyway. So, yeah, they're just going to take care of themselves, and that's the way the world works. So what are we going to do? We're also going to take care of ourselves. We're also going to make sure that we invest in a way that allows us to participate just like them in the great wealth transfer that's coming. Because when they crash this market, I guarantee you that all of those people are going to go into the market and buy everything up at discounts, and the wealth transfer is going to be unbelievable. So I would like to help as many of you as possible. Let's be one of them, right? We can hate them, we can call them names, but how about, if you can't beat them, join them. Let's just make sure that we preserve our capital on the way down in the big epic crash that is coming. Maybe not this week, but certainly in the next few years. Let's make sure that we're the ones that can also go in and start buying things that are on sale. That's the best thing you can do. I don't hate them, I just understand them. So let's leave it there. There's plenty to hate. There's plenty of, you can give me a dislike if you want on your way out the door. I would prefer the like, but YouTube does not discriminate. So engagement is engagement. If you want to hit me with a thumbs down, hit me with it. It also helps my channel. So thanks, everybody. And like I said, get your questions in early next time, and I won't skip so many. I do feel bad. There's a good 15 or 20 that I didn't get to. But take care, everybody.